Probal Sen, VP Equity Research at ICICI Securities, joining in on the show right now. Probal, hi, morning. Thanks for your time. And firstly, a word on the OPEC Plus output hike. Seems much tempered than what the market was anticipating, and it's keeping the oil prices as well under control. Do you think this 1% move is it?
Yeah, I think if you really look at the way oil prices have behaved and the way that OPEC has reacted very clearly, I think they are being pragmatic about how many additional barrels they can actually put into the system without impacting oil prices even more. Obviously, I think the demand situation still remains a bit uncertain for this year and the next. I think the estimates keep changing up and down depending on what kind of US inventory data we see. We have seen in the last couple of weeks that the US inventory data has shown a larger build than what was anticipated. So obviously, in that sense, your demand growth estimates, are a little bit weaker at this point of time. Again, they could change next month depending on what data comes through. But I think OPEC's decisions and OPEC's reactions in terms of supply additions are also being tempered to a certain extent on what is happening on the demand things. And I think that is push and pull, I think, will probably continue to happen. Nothing stops them from actually injecting additional barrels into the system if they see demand improving a little bit. But at this point of time, I think it makes a lot of pragmatic sense to sort of keep supplies tempered.
Right. Probal, hi, good morning. This is Harsh joining in. Let me get a perspective, therefore, on where we should expect oil prices to be. This 60 to 70 kind of range, is that a sustainable number that you see for the rest of the year? Is that visibility now far better, that oil prices will remain in India's favor, if I can call it?
No, you're absolutely right. Historically, what we have seen is when oil moves in a narrow range, that is always something that is good for Indian oil and gas companies. Obviously, leaving aside upstream, for 1 minute, because for upstream in India, what we've seen is if oil prices rise very sharply, typically the government has stepped in like it did last time and put in a sort of a ceiling in terms of their realizations. Barring that, oil trading in a narrow range is always good in terms of the margin scenario and stability of earnings as far as Indian oil and gas companies are concerned. As to the first part of your question, whether oil will remain in a narrow range, we believe so. I think our base case estimate continues to believe that somewhere between 65 to maybe 75, maybe not as much as a narrow range of $5, but 65 to 75 does seem to be a range in which oil prices will probably remain over at least the near to medium term, primarily because of the point that you mentioned earlier. OPEC is there sort of to balance out supplies and production to the extent that is needed. And on the bottom side, I think if crude sort of goes down a little bit more, then that brings about a demand reaction that brings it back into balance. So we would expect probably a bigger range that you mentioned, but a range nevertheless. I mean, there's no clear directions, of $20 either side at this point of time.
Sure. Probal, just a word on the OMCs. The minister himself believes that they are undervalued. Of course, we've heard that before. But where do you think they're headed?
I think the way I would look at it is, I think the kind of intent that has been shown by the ministry to sort of address what they believe are, perceptions which are maybe not correct on the part of the street. I think that is a laudable objective. They are showing that they are very, very clearly focused on interacting and communicating with investors, both on the sell and buy side, to understand where the concerns are and how to best address them. I think that is something that intent should be taken extremely positively. And as far as we are concerned, as I said, if I go back to my first point, as long as I think crude remains in this manageable range, we do believe that the three OMCs should continue to deliver better earnings. The retail margins at this point of time are still well above historical averages. GRMs have been a bit up and down, but our sense is that Singapore margins would probably still settle in at somewhere between a $3.5 to $4 range. So if you put that together, integrated margins, which is frankly what we need to look at, they might still be at 6 to 7 rupees a litre, which is slightly above historical levels and should deliver decent earnings growth. The second brief point is that the balance sheets are definitely much better, with the LPG compensation also coming through, or rather will come through some in this year in installments, and LPG losses itself at much lower levels, about 1/5 of what they were last year. The working capital, is not really a concern. So even with the higher capex, leverage in these three companies is actually at a much lower level than what used to be the case. So on that aspect, valuations as off between 4 to 6 times FY28 EV EBITDA and about 0.9 to 1.1 times price to book, I think are fairly comfortable levels to sort of add positions in these stocks at this point of time.
Thank you, Probal. We'll let you go on that note. Clearly sounding bullish where OMCs are concerned, sounding bullish where oil prices are concerned. Good to hear all of that from you.